Hey, what is going on, you guys? Today I'm going to be making a video over the death cross pattern. Maybe you guys have heard of it, maybe you haven't, maybe you're wondering what is it, how do I use it? So that's what I'm going to be covering today. Now, first of all, what is a death cross? The death cross, all it is, it's a pattern that indicates a major sell-off. It's whenever it's between two moving averages, which is a 50 SMA and a 200 SMA. All right, so this happens, whenever the 50, which is a shorter term moving average, crosses below the 200 moving average, which is a longer term moving average. So that's pretty much what it is. And when they cross, they make an X. That's why it's called the death cross, because it's an X or a cross, whatever. This is a very powerful indicator. It's been proven over centuries. This is a power indicator that has indicated some severe bear markets, such as the 1930s, 38, 74, the 2008, and recently this past December it happened again. All right, now why does this work? Okay, maybe you're saying, well, how does this work? Now, the reason why this works is because these moving averages, they're long-term moving average. Okay, it's something that happens. They average the days over a long period of time, as opposed to maybe a candlestick pattern or something like that. Maybe you're looking for a doji pattern or something like that. Usually, that happens day by day, so there's not much weight on the candlestick. Okay, now as opposed to these, it averages out basically 200 days or 50 days, and more so there's more weight to the moving averages. Basically, they hold more value. Basically, that's what I'm trying to say. So yeah, I'm gonna give you some examples real quick, show you what it does and how I take trades based on it, so maybe you guys can take trades as well, make some money. And these are easy trades. I wouldn't say easy, because nothing in the market is easy, but these are trades that, in my experience, they work about 80, 85, 90% of the time they'll work out. All right, that's in my experience. 95% of the time. Realistically, for me, it works almost all the time. Right here we got Apple, and this is on a daily chart. All right, I guess you could use it intraday. I'm not really sure. I use it on the daily chart. I've never really liked it on the intraday charts. This is more for like a swing trade, something like that. Maybe you're looking for a swing trade, so this is on a daily chart. So right here, the blue line is a 50 moving average. The 200 is a red one right here. So whenever the 50 comes under the 200, it makes an X right here, or a cross. If you look at it a little bit sideways, it's a cross. So it's a death cross. This is what it is. And this is the power it has. So check out that Apple. Once it crossed right here, boom. Okay, so that's Apple. Let me give you another example. And this is something that happens, I wouldn't say every single day, but it happens a lot. It happens daily. All you have to do is look for stocks that are coming into this type of range, and kind of have them down on a watch list. Maybe make a death cross watch list, add them to your list, check them out every day. And once they're getting closer and closer, you want to put them on your intraday chart, so when it does happen, you can get in a trade. Okay, so check this out. NUAN, it happened right here when they crossed. Boom, check this out. Gap down, boom. Even that's crazy profits right here. This is something called the golden cross, but that's another day, another video. Right here, you have another death cross right here. Boom, massive sell-offs. That's what the power of the death cross does. That's why it's called the death cross, because once it crosses, it's pretty much death. All right, so it happened here again. It crossed right here. Boom. Okay, that's pretty sweet right there. So it happened right here. Boom, major sell-off. So that's pretty much what it is. It's pretty much death. Happened. If you can guess where it happened, point it out on your chart. It happened right here. Boom. That's what happens with the death cross. Another example, JP Morgan happened right here. Boom. There we go. MPC, you know where it happened by now. Look at all this sell off. And this is just sell off for days. It's not like it. This is not something where it sells off for a day or two and then just bounces straight back up. All right. Now, I don't want nothing in the market is 100%, but, you know, like I said, 99% of the time, guys, this is going to drop for a couple of days. And when it does start to come back up, it's going to have a difficulty coming up. It's not just going to come straight up, you know, one day or whatever. Best Buy right here as well. Death Cross, boom. Check out all that selling for days and days and days. Okay, this isn't a 1 or 2 day thing, all right? This is for days. All right, and we're back to Apple. All right, so now you're probably saying, okay, well, you know, it doesn't really look good on the chart, you know, because the X is here, but it's already sold all the way down here, you know. So how do I get in the trade, you know? If the stock's already down here, how do I get in the trade? Okay, now, I'm not sure if this is technically how you're supposed to get in the trade. This is how I get in the trades, okay? This is what I look for. This is how I get in my trades. So what I'm looking for, daily, or not daily, but weekly, what I'll look for is the moving averages to start coming down, start crossing over, start getting next to each other, start getting closer to each other. And once they do, I'll add them to my list. So for instance, Apple, I'll have it down usually when it's around this area here. When I see the 50 coming down or something like that, I'll have it around this area here. And I'll have it on my watch list. And, you know, that's how I'll look for charts. Okay, so I'll take the trade. As soon as it breaks the 200 moving average, that's when I get in the trade. Okay, like I said, I'm not sure you're technically supposed to do it like that, but that's how I do it. Because technically, I guess you're supposed to do it like this, you know, which is, you know, a couple of days ago when this is, you know, when the 50 crossed the 200, this thing's, you know, it's selling off for, you know, 3 days straight. This is WBA Walgreens right here. Okay, selling off straight down, hard selling pressure. Like I said, I guess maybe that's how you're supposed to get in a trade, technically speaking, but realistically, it's not always hard. It's not always easy to get in a trade like this. All right, you probably gap down and you missed the entry or something like that, and you're thinking, well, I don't want to get in now because, you know, it's already too late, you know. So that's why I like to get in as soon as it breaks the 200-day moving average. Okay, as soon as I see them squeezing in like this. Now they have to be squeezing in. They can't be like this. It can't be like this, and then once it breaks here, get in. They have to be kind of curving down like this. Moving averages coming down. The stock looking bearish. That's what I like to look for. Okay, now let me go through these again and show you real quick. So as you can see, the moving averages are squeezing down. As soon as it breaks down, boom, get in it. All right, maybe you missed this day, and look at this. Breaks through again, boom. Okay, so you want to see the moving averages squeeze kind of like this, because what happens is when they squeeze, you have a whole lot of volume. All right, when you got a lot of volume and something does break through, that's when you get all this selling. Okay, that's whenever that happens. BX, check this out right here. It broke through right here. It's getting tighter and tighter. The tighter they are, the better it's gonna be. Okay, it's getting tighter. You get in right here. Look at all that volume increasing. Boom. That's what you're looking for. That's what I'm looking for, at least. That's how I take my trades. You want to have a stop loss now if you're gonna do a swing trade, which is what I recommend you do this for. This is not. I don't recommend you do this for day trading. You know, maybe you have two accounts, one's for day trading or something, one's for swing trading or whatever. This is something that you can take some trades and leave it on for a couple of days, you know, see how it does. If it breaks back over the 200, maybe give it a little bit of room, and then if it keeps going, just take it off or something like that. But usually they're going to work out. This is also a good way to grow your account. As you can see, it's not very hard to do, and like I said, it sells off for days. Okay, you can short the stock, You know, look at all that massive potential right here. Okay. Look at Best Buy. Look at all that potential right here. Now, you got to watch out for this. Sometimes they might retrace into the 200. Say you miss this day right here. Okay. Say you miss this day. And, you know, you see it retrace back to the 200. You can take a short here as well. You know, as long as it doesn't break over, you can take a short. Look at all that potential. Then when it does squeeze, boom. That's why you want to make sure the moving averages are coming in together and squeezing. All right. You can't just be getting in the trade, you know, if it breaks out down here, because look at the moving average. All right. So that's what you got to look out for. That's what the death cross is. Be sure and use it to your advantage. You know, make you know, start looking for stocks like this. Keep them in your watch list. You know, mark down on a piece of paper or something where you would have entered, and then check them out in a couple of days later. See where you would have been. Do that for a couple of weeks or something like that until you get your strategy refined, and you should be good to go. Start making some money. So that's pretty much it for this video. If you have any questions or comments or concerns, leave them down in the comments below, and I'll be sure and get back to you.